Just glad everyone got the email. All right, fellas, y'all see my screen?
You.
So, growing your network of investors, part 1. Capital raising, how to raise cash, how to talk to investors. The whole shebang. It's a beast in and of itself. A lot of people struggle with this part of the business. That's why a lot of people are scared of commercial multifamily or commercial investments in general, because of the larger amounts of equity or capital that are required. But at the end of the day, it's really not that difficult if you know what to do, if you're authentic, if you're honest, and if you go through these steps we're about to talk about. So number one in part 1, creating a sample pitch deck. So we're going to talk about creating a sample pitch deck, what that looks like. I'm actually going to show you guys a pitch deck that we've done in the past, actually with Chase Park, because I know we've used Chase Park as an example multiple times. So I figured we'd just continue the trend and use that as the pitch deck example as well. So walking through actually putting something like this together, and this is really going to help us, really going to help you as you start to go through this challenge and start to have conversations with people, because it's going to be something that you can physically actually show people. And we'll talk about more about what that actually means. So sample pitch deck is just going to be a document that contains everything about a potential deal, including photos, information about the building, area, actual financials, your business plan, projected financials, returns. Sample pitch deck is used with potential investors and even with other professionals that you're trying to recruit to your team or just potentially partner with, like brokers, lenders, insurance agents, etc. So the sample pitch deck is literally just a pitch deck. I mean, put the word sample in front of it because it's going to be a fake deal. It's not going to be a deal you legitimately have under contract. It's not going to be a deal that you're legitimately trying to raise for. We don't have official SEC docs on this. We haven't done all of that, but this is just going to be a deal that you find that you like, or a complete and utter fake deal that maybe even someone else did. Like you could use one of my deals for all I care. Like if it's the returns and whatever that you like, just as long as you create your own pitch deck, right? It has to have all of your logo, branding, your design stuff on it. But just find a deal that's going to be a fake sample deal, and then we're going to put together an entire pitch deck on that. And that's really going to be what you're going to use to approach, I guess I shouldn't say approach, but have conversations with investors. And we're going to talk about more what that looks like. So the difference between a sample pitch deck versus a real one, what we just said, everything about the building is accurate: photos, location, financials, except you don't actually have it under contract. So it's a legit deal. It's a legit opportunity. It's probably being listed. You found it on LoopNet or whatever. But you just don't actually, you're not moving forward with acquiring the property. You're just, yeah, I mean, if we were to buy this deal at this price with blah, 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 and all this blah, 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 and here's the business plan, yada, yada. If we did all these things, here's what the returns would actually look like and the structure of the deal. And it's really going to help you kind of be seen as a professional, because you'll actually have something that you're presenting to this potential investor. But it's not going to be something that you want to do necessarily on the first call. Now, if it comes up, some investors are very like go-getter, and they just want to immediately jump into financials and investing in business. And if that's the case, that's just their personality, then by all means, go ahead and do it on the first call. But my recommendation would be wait till the second call to do something like this. And on the first call, just try to build that relationship with the person, try to figure out their goals, figure out what they're trying to do, what kind of deals they're actually interested in investing in. Are you actually going to be a good fit for them, right? Like, is this going to be are they trying to double their money in a year, or are they in it for the long haul and they want the tax benefits? And is it actually going to mesh well with the structure, the type of investment that you're providing? So you may also lower the price so that you achieve the desired returns for the investors, or it's just a fake deal. So whatever actually pencils and makes sense on this fake deal, use that as your example for what the return structure would look like. In other words, you approach a potential investor with a deal package that looks and structured very similar to how you would structure your deals when the time actually comes. And having the sample pitch deck does several things for you, right? It allows you to better visualize your deal. So it's critical as you expand your own comfort zone. Know it was for me with doing your first commercial real estate deal or doing bigger ones than before. Seeing the photos, visiting the property, writing, talking about it makes the deal just a little bit more real. And the more real it seems to you at the end of the day, the more comfortable you become, and the more confidently you can actually talk about it, actually doing, and you're not going all out and doing legit due diligence on a deal that's completely and utterly fake, but you want to do enough due diligence and have enough understanding about the deal that you can speak intelligently on it. Because when you start to have conversations with certain investors, some are a little bit more sophisticated than others. And if they start asking you specific questions that you don't know the answer to, it doesn't look so great. Now, if you don't know the answer to it, just be honest. Be like, hey, I'm sorry, I really don't know the answer to that. Let me go back, talk to my business partner. Let me go back and do some research and find that answer for you. Don't lie and try to come up with something. But knowing all the answers that they're potentially going to ask you before you start pitching this fake sample deal will be massively beneficial. And again, help confidence and everything else, because confidence is huge when trying to raise capital and communicate with investors. Number two, it gives you reason to talk with your potential investors now. Right. Otherwise, you could be talking to them, right? You could be building that initial rapport. You could be having that conversation of learning a little bit more about them on maybe a surface level or a deeper level, the goals and things like that. But you don't really have an example scenario to show them. You can communicate, you can verbally talk about what the example scenario is, but you'd be surprised how many people out there are more visual learners. And it just gives you a greater sense of professionalism when you actually have something visually that you've put together, taken the time to do, that people get to take a look at and see. And this can be done obviously via Zoom call or in person. Can't really be done over a phone call because they won't be able to see it. So Zoom or in person is probably the two best ways to go about actually executing on these calls that you'll be having with people over the next 30 days and in the future. You can now schedule meetings with potential investors and say, I don't have a deal right now, but when I do, it'll look substantially or exactly like this. And then you show them the pitch deck. Help tremendously with this capital raising challenge, is exactly why I think this will be beneficial. Number three, it will allow you to get financial commitments from your investors long before you actually have a deal under contract. So by the time you actually get something under contract, you've already primed your investors with the exact type of deal that you're interested in, the type of structure, the type of return. Yeah, we do 10 pref, we do 8 pref, we do 70-30 split. Here's what it looks like. So instead of having to figure all that out when the time comes that the deal, that you actually have the deal and you're talking to them, they already understand all that. You've already talked about it. They've talked to their spouse about it. They've looked at their financials and they're ready to go. It just allows you to raise the money much faster. And that's ultimately what I did. I did the challenge back in June of 2020, raised the $6 million. 2 months later, we actually had an official deal under contract. It wasn't that difficult to raise the capital thereafter. Number two, how to actually go about creating the sample deal package. Step one, get the marketing package of a building for sale. We talked about this plenty of times as an OM, or if you can get an OM from a broker, that'd be the prime way to do it, because you can take a lot of what they've put in there and really just kind of copy and paste it into your own thing. Now, switch it up a little bit. You don't want people to be like, oh, he just copied and pasted this from Mark Similchap or whatever. Does he really know what he's talking about? Like, personalize it a little bit, get a little creative with how you actually put it in the pitch deck. But at the end of the day, a lot of what they've put in there, you can copy and paste either the words and just change the format or whatever, because a lot of it's going to be the same that you would want your investors to know anyway. So first step is find a property that's being marketed for sale or not, right? Like I said, you could use Chase Park as an example. Property should be about the same size and in the same area that you're looking for meeting your current buy box criteria. So maybe Chase Park isn't the best idea. If you are struggling with actually finding deals in your area, then it could be a potential option. But I think the best option would be like find a deal in your actual area, like the market that you're actually already targeting, that you're going to try to buy in, that your investors are going to be interested in, and be like, hey, if we bought a deal in this market, here's my already buy box anyway. So if I bought a deal that looks just like this, and here's the example deal that looks just like this, would you be interested? Right? Should have a good marketing package. I should have photos, financials, rent roll, unit mix, maybe some information about the area, demographics, typically from a broker. A variety of websites that list multifamily properties. You guys already know this. For the purposes of creating the pitch deck, you can use LoopNet because it's free, easily searchable. Go to loopnet.com, create an account, log in, search for properties that match your criteria. And sometimes you can just download the marketing financial package. Other times you got to like actually reach out to the broker to get the data in the first place, which is totally fine. Then you're talking to brokers, right? Then you're having relationships with them as well. Look for a property that has a marketing package with at least photos, financials, rent roll, unit mix. It's a bonus if it has all the extra goodies, good stuff for demographic information or rental and sold comps, because that could be something that you want to include in your marketing package and your pitch deck. But sometimes there's no like crystal clear answer for this, because a lot of people say, well, what am I supposed to like? What are the exact things I'm supposed to include in a pitch deck? There's not really a clear answer. There's a general synopsis, general idea of what you want to include. But at the end of the day, you want to make sure you're just really zeroing in and focusing in on your like target market from an investor database perspective, because some of your investors, or maybe all of your investors, may not fully comprehend, understand, or even care about the demographic information or sold comps or anything like that. Maybe they just want to know the business plan, the financials, the returns, and they're good to go. They just fully and utterly trust you and all the research that you did. So you don't have to add all that extra stuff in there. It's just going to waste space, waste time, and they're going to get bored from being on your webinar or hearing you talk about it, right? So it's really going to depend on who your actual investor base is, which is going to help us really like market and target this sample pitch deck that we're going to put together for that. Now, if you don't know who your target audience is, right, we're just getting started raising cash here, then I would say just go ahead and include it anyway. And you'll just hopefully be able to tell, hopefully, as we continue to have these conversations, you'll be able to start to see and sense people's like boredom and their non-caring or facial expressions as you're starting to pitch these things, when they're just like glazed over, could care less. You can see them just nodding their head like this all the time. And it's like, all right, I don't even know if this guy's listening. So maybe at that point it's time to take it out. But yeah, body language is everything when you're pitching something. Step 2, create financial projections. Marketing package you download should contain all the actuals and projected, which again is why it would be beneficial to just find a deal from a broker, because probably already going to have all that stuff in there anyway. Makes it very simple for you to just copy and paste and then change a couple of things up to have your own sample package. Create your own 5-10-year projections or perpetuity model projections in Excel using the underwriting analyzer. Use it to calculate the potential returns for investors. If the marketing package you downloaded contains financial projections, you just reuse those either by copying them into a spreadsheet or doing a screen capture. Most of the time, the financials in the marketing package are gross exaggerations, as we know from underwriting the many of deals that we've done. Gross exaggeration of the truth. So it's important to create your own version of the truth for any pitch deck that you create. So, however, for your sample pitch deck, now that's what we're going to want to do if it's like a legit deal, right? If it's a legit deal, obviously we're going to do our own underwriting, legit due diligence. We're going to have all our T's crossed and I's dotted as far as like the financial projections of this deal. But in a sample pitch deck, do we really need to do all that? Probably not. The accuracy of the financials is a little less important in the sample, because as you're going through it, you're not literally pitching it as if this is a live deal and you want them to commit today. It's just like, hey, there may be some granular questions that you may have that I'll be able to answer when we get a very specific deal for maybe a financial perspective. But on a very 30,000 foot view, here is the example investment that we would do. You know, here's the purchase price we would invest in this market. Here's why. Here's the rent that this is currently at. Here's where it can go. Here's why. And here's why we like this kind of deal and this kind of asset class and this kind of area and this kind of size, because here's the returns we're going to be able to project if we buy a deal just like this, that, you know, meets all this buy box criteria. So at the end of the day, what's important, the whole purpose of putting it together, is that you actually have something to talk about with your potential investors. You don't need to do hours of due diligence, get all your projections right. It's really not the goal of this step of this project. Your goal is that it's representative of the kind of deal that you want to do, and that it emphasizes the terms of your investment that your investors could expect when the right deal comes around. So step 3, actually creating the sample deal package, the pitch deck. Executive summary. Short section, half to a full page. Contains a summary of the investor terms, preferred rate, equity, projected returns, minimum investment, term of the investment, a description of the property, and an overview of the business plan. Renovate, raise rents, exit, hold in perpetuity, invert cash flows, etc. Property information. This section contains a description of the property, some words about the area and the unit mix. May also add the business plan for this property. For example, if we're going to renovate the units and make other cosmetic improvements to raise rents, that would go in the section. Financials. This section contains rent rolls, actual financials, projected financials and returns. Section contains the 5 and 10-year or perpetuity model financial projections and the ultimate estimated returns for your investors, which is also going to include kind of like the structure of the deal. So you'll have your business plan, you'll have your financials, projected financials, pro forma, and then that's also going to include how's it actually structured? Like, how am I actually getting paid this? Well, it's because it's a 70-30 split and you this, and this. And so here's what it'll trickle out to be. About the management team. Here you have a short bio of yourself, as well as for some of your other team members. For example, your property manager, attorney, CPA. If you have any other important partners, list them here. This section gives you credibility as someone who'll be able to put a deal together and close. That's really what you're doing with the about me section. Like, here's deals we've done in the past. Maybe you put not necessarily like all the detailed info about a deal you've done, but maybe give like a link or something for them to go check it out if they really care. If they don't care, just say, yeah, we've closed 90 units. We've done this. Or if you haven't in particular done it, borrow some credibility from your business partners if they've done it before, or borrow credibility from me. You know, you could literally add me in your pitch deck and say, here's who I'm directly connected to. Here's everything they've done. And I can lean or glean or whatever the word would be directly on this person to help raise cash or be the KP or do whatever. So here's why we're going to be successful, right? Here's all the experience and background we have. Now, PS, everything, this section here, this is not the actual order that you should put them in. And then we'll talk about this now. So I was listening to a podcast actually on Bigger Pockets. You guys should go give it a listen. It was pretty neat. I don't remember the guy's name. Feel bad. But it was a guy that they had on specifically talking about like pitching deals. And he wrote a whole book about pitching. His whole like basically like sales is kind of this guy's expertise, and been doing it for what, 20, 30 some odd years. Wrote a really awesome book about like you can pitch anything or how to pitch anything or something like that. Anyway, they had him on and the whole concept was talking about like pitching deals to investors, what it actually looks like, pitch decks. Do you do live pitches? Do you do it'd actually be very beneficial for you guys since this is exactly what we're going over right now. But anyway, he mentioned that a lot of people, when they put the pitch deck together, they put it together backwards. Like a lot of times people will do the about me section, the like, here's about, they put it at the very end and they put all of the good juicy stuff at the top. They put all the like 8 pref, double your money in 3 years. It's going to be freaking awesome. Like, got to jump into this deal. It's going to be great. But then he was like, if you just think about anything else in the world, any story that anyone's ever trying to tell or any sale anyone's ever trying to give, you're not putting the punchline right there at the beginning. You're not coming out the gate being like, hey, Sally dies at the end of this movie. What? Like, no one wants to watch the movie. Everyone knows Sally dies. So you want to start off, the way he was explaining it is basically you want to start off with like the about you. You want to maybe a little bit of an executive summary, but not like all the actual financial projections. So he was like, basically what you need to do is what I see most people do when they put together a pitch deck. You want to do it backwards. So you don't really want to give out all the good, juicy, detailed information first. You want to start talking about the demographics of the area. You want to talk about the market. You want to talk about why you like this deal. You want to talk about why you're investing, how much GP equity you're actually going to invest in the deal. And then talk about yourself, about the management team, why you believe you're a good fit to actually execute on the business plan for this deal. Talk a little bit about the business plan, but not necessarily the financials yet. And then the punchline is at the end of like, bam, jump into this deal because you're going to double your money in 3 years. You're going to get an 8 pref. It's going to be great. Now, I only recently heard this podcast like a couple months ago. So the example pitch deck you're going to see is not in that order. It was in the order that everyone else puts it in, which is about me at the bottom and basically this. But from what he said, it made a lot of sense. And I think that's probably what we're going to do in the future is try to just rearrange it just a little bit. And then when we're actually going through the webinar or going through a pitch with an investor one-on-one, we'll have it structured in such a way that it's much more of like give me more kind of thing. Like, I want to know more. I like what you're saying. Give me, like, they want to stay listening. They want to stay tuned in, and they ultimately want to get involved at the end because you've like sucked them in at that point. Whereas you give them all the good juicy stuff in the beginning and then just bore them with all the boring reasons why the deal's okay afterwards. So anyway, I thought it was a really neat episode. It's actually a 2-part episode on Bigger Pockets. If you guys want to go check it out, it's probably going to say pitch anything or how to pitch anything or something like that. Pretty good episode. Number 3, how to find your potential investors. Surprising who your family, friends, and neighbors and coworkers actually know. Because again, if you guys remember, when I first did my challenge, I had like maybe 1,000 friends on Facebook, didn't have a LinkedIn account at all. So I was just going live on Facebook. 30 days later, raised $6 million. But most of it was from referrals, not from people that I actually like knew. Like, I raised maybe about $1 million for people that I knew, but I was thoroughly surprised at all the people that I knew and who they knew and their interest level in the business. Never discount anyone, even if you feel like they're a little shady, they're just weird, you're not sure that you want to be on the call with this person. I'm telling you, it's happened to me before. you're just so uncertain. You feel, or I feel certain that they're weird, that this person does not have money and is not interested in investing with me. And then sometimes I'm right. Sometimes they themselves actually end up not being interested. But I always ask the referral question. And I always go all the way through the pitch. I never just like stop, because you just never know. Like, they look weird, they act weird, they may be weird, but at the end of the call, they're telling you, hey, I got $1 million. Like, I want to put it into a deal. I like you. Let's make something happen. Or they have no money and they were just interested in learning more about the business in general, but they know someone with money. Like, maybe their coworker or their boss or their best friend or their uncle has some capital that they've always talked about putting into something. And when you ask the simple question of like, hey, is there anyone else that you may know that may be interested in an opportunity like this? And they're like, you know what? There is actually someone that I know. You can never discount anyone, because you'd be utterly and completely surprised at who actually gives you a referral and who they end up referring you to. Tell everyone you know what you want to do, and you'll be surprised at what will happen. If someone refers you to someone they know, always follow up. Always, always. If that person will not invest, she may invest later, or she may be able to refer you to someone else. So it could be an endless, vicious cycle of referrals. If you end up getting a referral to someone, or if you have a conversation with someone, the follow-up is key. But then if they decide that they're not going to invest with you today, that's fine. Maybe they'll invest with you in the future. I've had investors that have been like following me for 3 years, and they're like just now interested in getting into deals. Like, yeah, I've been seeing you do a ton of stuff over the last couple of years, closed a bunch of units, done whatever. I think I'm interested in getting involved now. I see that you're actually legit at this point. I'm like, wow, it took you 3 years to figure out I'm legit. But nonetheless, some people are just slower than others, and just keeping in touch with them, whether you're just continuing to follow them on social media or continuing to keep them in your CRM or any of those other different ways you can like find those touch points with your investors. You never know when the time's actually going to come that they do become or decide to become interested. And it's also a timing thing. Some people could have a ton of money or whatever, and the timing's just not right for them. Like, they're just not ready to invest in a deal right now, or something just happened in their business. I've had that happen to investors before, where they were like, I had a lot of liquidity, but I just gave up the liquidity, or something just happened and now I need the liquidity. So I don't know that I'm ready to invest. And then like a month later, we had another deal, and he's like, yeah, that whatever I was telling you about earlier, we fixed it. It's gone. Problem gone. I'm ready to invest. And then they had a bunch of money they were ready to put into it. So it's just like a timing thing. You just never know. But the conversation might go something like this after you dispense with the small talk. Working on something new maybe can help. Oh, looking to purchase a multifamily building in the blah, blah area with a group of investors. The annual returns are expected to be around 13%, and the minimum investment is 50,000. You wouldn't happen to know anyone who might be interested, would you? Or would you? They might say, well, I might be interested, or she might refer you to someone, or she might say that she doesn't know anyone. She's interested herself, schedule a meeting with her. She knows someone, have her make an introduction, follow up with that person. Make sure you keep Susan informed about all the progress. Your goal is to have as many in-person or Zoom meetings with potential investors as possible, because it's going to be the best way that you're actually going to be able to present the visualization. You don't just want a phone call. Phone calls are okay, but I much prefer to actually be able to see the individual's face. It just fosters a deeper level of connection. And ultimately, it helps you be seen as a little bit more of a professional, because then they're able to see that you put the pitch deck together, which is why we're putting it together in the first place. So that's definitely what I would recommend. But the purpose of this is like you're having a chat with them. Maybe this isn't even like over the phone. Maybe this is like you're DMing someone, right? They initially DM you or PM you, and they saw something that you posted day 1, day 5 of the raising challenge. And they're like, hey, I saw you post something about the capital raising challenge. Saw you're doing something in real estate with investing. I'd love to learn more. And so then you can bypass that. I'm working on something new. You can say, yeah, thanks so much for reaching out. Great to hear from you. I'm actually looking to purchase a multifamily building in the blah, blah area with a group of investors, blah, blah. Minimum investments, blah. You wouldn't happen to know anyone that might be interested or whatever. So the script there obviously can be tweaked many different ways, but it's just an example of something you could say in the DMs to get someone ultimately on the phone, because you're doing this in social media. So everything's really going to come through DMs, PMs. Maybe they'll email you if you add your email or something in there. But primarily, you're going to be conversating with people to try to get them on a phone call or on a Zoom call or in-person meeting if they're local. That would be ideal. I would tell you, however, I've only had like a handful of in-person meetings with investors. So virtual, Zoom, totally fine. Okay, number 4, who your ideal investor is and who ultimately to avoid. Institutional investors are investors who invest professionally. These could be angel investors. These types of investors have access to lots of capital, see tons of deals, and can therefore be very selective about the deals they do. They've probably also been burned a few times, so they construct the terms of a deal so that they're very much in their favor. They'll ask for high preferred rates of return, big chunk of any upside. They want to make sure they're paid before anyone else, including you. I think institutional investors most definitely have their place, but I'm just not ready for them at the moment. If you're buying a 150 unit for $7 million, you need to give up 80% of the cash flow in equity. That still leaves you a good amount for you as a syndicator, but apply that same logic to a $1 million deal, and it's just hardly worth doing the investment in the first place. Based on my experience, institutional investors become more relevant after you've done a few deals. Your deal size grows. It becomes something maybe required even at that point when you start to do really big deals. That's because institutional investors almost always insist on track record as well. The more track record you have, the less you have to give up. That's why when you're first starting out, you would need to give up way too much to an institutional investor to make it worth your while. So the other option is friends and family, which is going to be the primary individual we're really going to be raising from. Friends and family, and what I'm calling high net worth individuals, which is basically also just friends and family, but just a little bit higher caliber of an individual. So we've already talked about this investor. These are the people you already know, your friends, family, neighbors, coworkers. These people trust you for the person that you are, and they will care much less about the deal itself. Now, they still would like to see a sample pitch deck, because that will just help them visually understand what it is you're actually talking about, especially if they're a newer investor. If they're someone that's not super familiar with real estate, but they have a little extra cash and they're just trusting you to put it into something, or they want to do a little bit of research, but not a ton. They're not as sophisticated. That's where this will come into play. So they'll invest with you simply because they trust you'll do a good job for them. Friends and family can typically invest or loan anywhere between 50,000 to 100,000 maybe, and often have that capital in their IRA or other retirement account. That's what we found, that a lot of those kinds of investors are like, yeah, I got an old retirement account for an old job I used to work at, or I've been working at this job for 30 years. My retirement account's got a couple $100,000 in it. And yeah, I'd be interested in investing with you. Can I even invest in an IRA? Like, is that even a thing? I don't have like liquid cash, but I've got this big IRA. And it's like, yeah, well, absolutely. You absolutely can. And here's how you can do it. Don't talk about any confusing investing concepts with this kind of investor. For example, you might not necessarily even need to mention IRR, because your friends probably won't even know what to do with that or what it even means. I'm going to be honest. I think I mentioned this, but it took me like almost a year to figure out what IRR was. It's like, this calculation doesn't make sense. This metric doesn't make sense. I'm still trying to figure out what what this metric means. And again, it took me about a year to finally determine that it meant basically the time value of money, to try to simplify it in the most simplest form. But if I'm being honest, IRR is somewhat of a complex calculation. And so I don't typically like to talk about that with people that seem less savvy, because it just confuses them. Your friends aren't going to know what to do with that. Talk instead about the average annual return. Much more simple to understand. Super simple math that hopefully they did in high school and they'll understand. Your friend will ask you, if I give you $50,000, what will I get back in 5 years? Question is answered not with IRR, but with average annual return. Simple terms: if after 5 years, combination of cash flow, loan amortization, profit at sale equals 50%, then 50% divided by 5 years is an average annual return of 10%. Simple interest. Like, yeah, so you're going to get a 10% average annual return over the course of the life of this deal, but you're not going to get it actually every year. So you won't be receiving 10% cash on cash, which is the next paragraph here. Something that that's something that your friend will understand. Your friend will also understand cash on cash return. Let's be able to talk about that as well. Cash on cash may be closer to 2% while we do the renovation or business plan. But then once we hit year 2, year 3, your cash on cash will go closer to 8 or 10%. And then your overall average annual return over the course of the entire 5 years, when we go to sell or do whatever, hit our exit, then you'll get 50% or whatever. They'll want to know what they can expect to be paid every year while they're actually investing with you. Now, the higher net worth investor is obviously probably going to be someone we would love to target much more than friends and family, because they've got a little bit more cash. The higher net worth investor is oftentimes a successful business person, professional. They can typically invest $100,000 or higher, and they're typically already made some other alternative investments outside of the stock market already. Treat these individuals just like you would your family and friends. The only difference will be the amount of minimum investment, and maybe they're a little bit more sophisticated, but honestly, I just like to keep things super simple. Confused investor says, confused just individual says no. So if I can keep things as simple as possible and make sure that everyone's on the same page, especially with the perpetuity model, guys, you guys know you had a lot of questions about the perpetuity model when I was explaining it. So sometimes trying to explain that in the simplest fashion that you possibly can is what I typically try to go for. I'm not like, oh, it's going to be an IRR of 27.3256 and 9%. And here's how I know that because all these other excess calculations and you've invested 100K. And so here's how that trickles out in your finances. It's like, dude, you're going to get a 50% like loss on paper. So you're going to give me 100K. I'm going to give you $50,000 loss back. So you're not going to pay taxes on the 100 grand you gave me. On top of that, I'm going to give you 10% of the investment you gave me year over year for 3 years until I give you your initial investment back. And then we're just going to cash flow indefinitely. And they're like, well, that sounds simple, right? That sounds too good to be true. They may even say, and it's like, okay, well, if you want me to dive a little deeper, we can get a little deeper into it. But the very simplistic perpetuity model is that. Be aware that you may have to deal with concerns and objections that you didn't have to address with your friends and family, because again, they're just slightly more sophisticated. Higher net worth investors may ask you more sophisticated questions about the deal that you should be prepared to answer. So in summary, if you create a sample pitch deck, it'll simply make it much easier to have conversations with investors. You'd be surprised how many investors are visual learners and have something to, or want to have something to review, to look at while on the first or second call, and how that'll actually ultimately drastically increase your professionalism. And that's it, gents. So the next thing I wanted to do was show you basically this example pitch deck of Chase Park again. So we've used Chase Park multiple times as an example in underwriting and picking target markets and a whole bunch of things. So I figured let's just keep the trend. And now that you guys have hopefully a deeper understanding of Chase Park, this will make sense. Now, for whatever reason, Google Drive likes to make this picture look extremely blurry, but it wasn't initially blurry when I was sending it to people. So don't let this fool you. But, a little funky thing here. We decided to take the funk out. This was a deal we did back in September, October of 2021. So it's been a little minute since we've done it. It's been over a year. We've switched things up a little bit. So we took this extra funk out, tried to keep it simple, maybe just a blue line here or an orange line or whatever color scheme you want to choose. Just saying, here's, the name of the deal. We weren't calling it Chase Park at the time. 88 units. You could say A class if you wanted, B class, C class. You could say a handful of different things that just give them an understanding of why am I even looking at this in the first place? Like, what am I looking at? Table of contents. And again, I did mention that this isn't necessarily in the right format that we were just talking about. So you would probably want to do it in a little bit different format. This is just the example of what you could utilize in your sample pitch deck, shifting it up a little bit. Add a little disclaimer in there. It's not like super pivotal that we add the disclaimer, but little legal disclaimer to our investors. See, investment highlights is the first thing we did, right? We fell prey to what everyone else does. So I would maybe include this a little later. But 10 pref, quarterly distributions, how often are you going to distribute? What's the ultimate split? Is there, with the perpetuity model, you're going to get 100% of your capital back in year 3. We're going to infinitely get infinite returns thereafter after the refi. Here's the minimum investment. We're doing a 506B, so we can accept accredited and sophisticated. IRA, solo 401k, EQRP funds are accepted. And here's where our projected year 1 depreciation is via the cost seg we were going to do. Because these are basically all these highlights here is like the main question I get every time from investors. Like, is there a pref? What's the split? When am I going to get my capital back? Is there an exit? How often do you distribute? Can I be sophisticated or I have to be accredited? What's the minimum investment? Do you take IRA accounts? And what are the ultimate tax benefits of this deal? Literally all the main questions I get about a deal. So we were just like, all right, that's all the investment highlights. Everything that people are probably going to ask us, we'll slap right here. So why are we investing in the deal in the first place? Well, attractive 56K door purchase price, newer Class B asset, built in 2004. Unique opportunity, property exited low income housing tax credit August 20th, which is why we have the opportunity to own a Class B 2004 built asset with upside. 100% return of capital end of year 3, infinite cash on cash return for a long-term hold. Sometimes we'll put in here how much we're actually investing as GPs to just help the investors know we're a little more aligned with them. Like, yeah, GPs are going to invest $1 million in this deal, or something of that sort. Financial overview, loan details, what's the purchase price, what's the renovation budget, right? Just a little bit of the financials. You don't ever want to just try to like copy and paste your underwriting and put it in here, because it's going to be so convoluted and confusing for your investors. And it's going to just raise more questions and more red flags than it is actually going to help explain anything. So it's better to just take out all the data from that and put in your own quick, much smaller little explanation of the numbers. That's just super simple. Reserves, working capital, closing, acquisition costs. Are you charging an acquisition fee? Is there going to be a capital transaction fee? Is there going to be an asset management fee? All right, talk about all the fees on the pitch deck. 2% for this one, total cost, loan amount, minimum actually needed to close, right? Here's the actual total equity that we would like to raise. But if we just get 1.2 in the bank, we can still close and raise the rest after closing. So we usually add that in there. Then some loan details, interest rate, loan term, 3 years plus 2 1-year extension options, bridge to agency, and a little picture of one of the properties, one of the buildings. Partnership structure. What's the actual structure? Well, the goal is to return capital ASAP, take risk off the table for LPs, enjoy infinite cash on cash returns thereafter. 70-30, LPGP equity, 10 pref, 100% of distributable cash flow does go to the LPs for the first 10% each year. Above 10% pref, 100% of the cash flow goes towards return of member capital, basically. So if we get a 12% return in the first year, we're going to pay their 10 pref, and I'm actually going to hold back the other 2%. I'm not going to give it back to them because it's just more confusing for the investor. You'd be surprised how many investors don't understand preferred returns. And so if they give me $100,000 and I give them back 12% as opposed to 10%, and 2% of that goes back to their initial capital they invested, they now only have 98,000 in the deal. Their basis is dropped by 2,000. So when I give them their 10 pref the following year, it's only going to be 9,800 instead of 10,000. They're gonna be like, hey, you owe me $200. What the heck? Why'd you short me? And be like, nope, not what happened, because I gave you your 2% back, which dropped your basis over the 10% we promised you. And then it just gets confusing. So we just hold all that back into a separate account, and we just basically put it towards paying back 100% of their initial investment at actual closing. Now, that was when deals were piping hot, and prefs and cash flows and cash on cash returns were ridiculous over the last couple of years, and everyone was over exceeding projections. However, now things are a little bit more stringent, a little more tight. So if we did have any overages, that would be what we did, but probably won't have many overages in today's market, unless you can get a really creative, awesome unicorn deal. Let me know if you do. After projected cash out refi in year 3 and 100% return of member capital, LPs maintain their 70% equity, but they now receive 30% of the cash flow and future proceeds. So again, that confuses some people. So when I say equity, I just say anything on paper. Your initial 70% that you bought in at, the K1 I'm going to give you, that piece of paper, still going to say 70%. Still going to say you own that, like you're going to get that 70% pro rata share of taxable losses long-term, and then net worth if you care about it. Investment summary. What is it actually going to look like, me as the investor, if I give you 100 grand? What do I get? Well, here's what you get. 10 pref year over year for 3 years, cash on cash return. You get your capital back in the 3rd year from the refi. And then after that, can't tell you what the cash on cash return is because it's infinite. I can tell you what your cumulative return is, but this is infinite also, average cash on cash. And you're going to receive 4,000 in the first year, and then years 5 through 10, and then on, it'll be, you always like to tell them the worst, but hope for the best kind of thing. Like you're planning for the worst. So worst case scenarios, you'll get $3,500 a year annually, about 3.5% of your initial investment for the life of the deal. Best case scenario, it's going to be much higher than that, but I'm not going to tell them what best case scenario is because who knows? And the reason that these numbers are different between year 4 and 5 is because year 4 is the IO period. So with interest only, we're not paying any principal. We have a little bit more heavy on cash flow, and then IO ends year 5 and they're on, and now we're paying principal. Cash flow is just slightly dipped a little bit. So projected returns after refinance. That's basically this. We would have excluded that. We've excluded this in all future pitch decks, but it's basically this explaining what this actually is. 4,000 per 100K invested during interest only years, 3,500 per 100K invested after interest only years. Now, this model here is kind of confusing. I'm going to be honest. I've been confused by it multiple times. So what we did is we took this is basically the traditional versus the perpetuity. You guys remember when we went over that and I showed you the spreadsheet Matt spent however many hours putting together to show the difference between the two. So we basically just took a couple of graphs from that and have tried to simplify it as much as possible, as opposed to being like after cap gains and recapture additional return if assets are sold. Here's all of our assumptions. Like investors look at that and get a little confused and they're like, I'm not so sure what's happening, right? Because then they talk about if sold, long-term model, equity, traditional long-term model, a little convoluted, a little confusing. So we've taken these out and we replaced them with the graphs that we created from that actual sheet, which say sheet should be in the Google Drive. If you guys want to go, if you're looking to do the perpetuity model yourself, grab a couple of graphs off there and add them in your own pitch deck. Business plan, definitely something you want to put in there. I'll be surprised how many people don't actually put a business plan in. They just put all the financials, demographics, about the sponsor, but it's like, what are you actually going to do with this deal? You're telling me what the returns I'm going to get, but how are you going to achieve that? So definitely want some form of business plan in there. Transition to local property management, begin exterior and interior CapEx, implement renewals, new leases at max rent for rent restricted units, implement renewals and new lease at market rent for non-restricted units, implement utility bill back schedule, capture other income, pet rent, etc. Explore the cost benefit of low flow fixtures, projected cash out refinance in year 3. This is a super layman term business plan. Like if someone just wants to know what exactly are we doing to execute. Now, if someone wants a detailed explanation, we give the business plan timeline, which goes into a little bit more detail, which hindsight, we probably should have put this closer to this and not so further down. Some of the stuff's jumbled. We've gotten better since. Rent targets. Rents are currently well below market because the property was in a low income housing tax credit program till August 2020, blah, blah, blah. Going over what all that actually looks like. And then since this is a LIHTC deal, looking at restricted units versus market units and what our expectations are, what we're going to get on rents in year 2, year 3, and then year 3 cool down period ends, switch to market rate for everything. Actually giving them the plan of how our rent growth was going to look. Capital expenditures, property improvements, what are we actually going to do? So we talked about the business plan, but what are we actually going to do? So we're going to install new roofs, upgrade amenities, convert old pool area into community area, barbecues, awnings, games, implement the key fob system for the gym, upgrade the playground. We basically just replaced the entire playground. Add additional amenities like dog park, dog waste stations, upgrade unit interiors. We even added, I think, a computer, like a business center or something, but upgrade unit interiors, paint cabinets, install new hardware, install new vinyl plank flooring, paint walls, etc. So business plan timeline, more intricate thing. Months 1 and 2, immediately transition property management, address lender required repairs, deferred maintenance, begin interior renovations, target rent for lower cool down periods for the 1 beds, 2 beds, 3 beds, target rent for market rates, 1 beds, 2 beds, 3 beds, implement the utility bill back and other income schedules. Months 3 to 10, continue those renovations, continue to lease newly renovated units, the highest achievable rent, transition good tenants into renovated units to increase turnover, and so on and so forth. Assess market and prepare for refinance, months 24 to 36. So that's a little bit more of a granular breakdown. So in your sample pitch deck, I'm gonna be honest, business plan doesn't have to get this granular because I don't want you to do this much due diligence on a deal that's a fake deal anyway. So you could put the basic business plan if it's like, here's what I think we would do, right? If this was a deal we were going to go into. The roofs look bad, they look rough, we'll replace the roofs. Siding looks bad, we'll replace that. Interiors look like it needs this, this, and this, we'll replace that. And here's the rents we'll be able to achieve once we do that. And here's how the financials all flow out after doing that. So I would keep things very simple, especially in a sample deck, but this example wasn't a sample deck. So we got a little bit more granular with it. We always include a little cost segregation, tax saving slide of like, historically, here's what we've seen for how much depreciation you can see in the first year. Not necessarily promising that you're going to get that, but here's what we've seen on like every other deal we've ever done. So probably going to be something close to this. Consult with your tax advisor, right? Got to put that little disclaimer in there. Property overview. What are we actually purchasing it for? Year built. What's the current occupancy? How many units? Little picture. Some more pictures of the interiors, what they currently look like. Even now, we actually like to also put in pictures of what they're going to look like. So like, here's what we're hoping to do to the properties. Not typically, it's not like the exact same unit that we got professionally edited to look like it was renovated. It's typically just the comparable property across the street that already did the renovations that I'm basing the renovations off in the first place. Like, here's what we want the unit to look like once we finish upgrades. Little layout here. We don't always include this either anymore, honestly, but you can include the layout, property interiors, property exterior, where everything's actually laid out, trash compactor, got your storage building over here. There used to be a pool, but that since got filled in, got all of our buildings, little retention pond over there, the gazebo's over there, the playground's right here. I think we added the dog park right here. Yeah, a little picture here. Now you could also do, for people like Luke that are fancy, you could do what's it? Drone footage. You do drone footage. Have a little drone footage video of your property. That would probably be pretty cool. Property exterior, more pictures, Chase Park Apartments, more exterior photos, rent comparables. So then we dive deep into the actual rent comparables of some other assets. Well, I guess it's just one asset. The retreat at Dublin Creek was the main one we were looking at. So we're looking at Chase Park current versus what we were hoping to achieve, Chase Park pro forma, versus what the retreat at Dublin Creek, which is our primary comparable, literally right across the street. There's the retreat at Dublin. Here's Chase Park. What they're actually achieving versus what we're getting, or what we even suspect to get. We even suspect to get less than what they're achieving today. So we felt like we were being very conservative in what we could achieve. And then I think I told you guys this retreat at Dublin Creek literally sold like a month after we closed on this one. We bought this one at what, 56 a door or 58 a door. And then this one ended up selling for like 111 a door, like a month after we bought it. And so this is the building. This is the retreat at Dublin. So Chase Park was a 2004 build, fairly comparable to the 2006 build right across the street. Retreat. This is the interiors. Financial projections, pro forma, actually including what things are going to look like over the course of however many years you wanted to include. If you just wanted to do 3, end at year 3, refi happens, we just, in perpetuity, we're getting cash flow after that. You could do that, or you could do 5 years or full 10 years. The fewer the better, again, because you don't want to just confuse people. So the fewer numbers and confusing calculations you can put in, the less likely they'll be like, hey, well, what's that? That number doesn't line up with that number. You know what I'm saying? So keeping things simple. Rent escalator, what's your expense escalator? Honestly, the expense escalator should have been higher. Shoot, freaking inflation at like 8 to 10%, but whatever. Live and you learn. This deal still ended up being our best freaking deal. We did a calculation. It's totally off topic. We did a calculation on this property. It's funny that this is the example property that we use, because this is literally like our golden child. With financial projections that we as GPs are actually going to receive when year 3 happens, we execute on the refi and then invert those cash flows 70-30. So we're trying to figure out how much actual passive income are we going to be making as 3 Beach Capital when all of our deals invert and we hit perpetuity model 70% cash flow status. And this deal is like 3 times more cash flow than our next deal in terms of like actual cash produced by it. This deal is probably going to put off, right here, it's going to put off like 391,000 or 325 or something along those lines. And then we'll get 70% of that. So we were like, well, dang. Our other deals aren't quite producing that. So Chase Park's a little bit of a unicorn opportunity. But anyway, adding all of those financials in here, keeping it 2 years, 3 years, 4 years, 5 years, whatever you want to do. Like I said, the simpler, the better. Gross potential rent. What's that look like? Average rent, economic vacancy. Some of these things we've like kind of gotten rid of, like total other income. We'll just eradicate, because then people are like, well, what's included in the total other income? It's like, just forget it. Pretend it's not even there in the projection. Economic vacancy, operational expenses, replacement reserves. What are we doing for that? Because again, replacement reserves is actually outside of, or it's a below the line expense after NOI. So the net operating income is 389, blah, blah, blah. But then net cash flow, basically what this is we're going from net operating income to net cash flow and subtracting the mortgage. We just didn't actually put it in here because didn't want to confuse people. So what's our debt service coverage ratio based on these numbers? Pretty high, right? Much higher than the 1.25 or whatever it is they were requiring at the time. And what ultimately is our break even occupancy, right? What's worst case scenario? If we get down to 52% occupancy on this asset, are we still going to cash flow? Are we going to be in the red? Are we screwed? Nope, we're good. 52% and we're still solid. So that's typically a neat little metric that is kind of like a risk adjusted metric that helps a lot of our investors feel comfortable. Mostly now they already feel comfortable knowing we've underwritten it and like it, but yeah, it's also just a helpful metric. Conservative underwriting, talking a little bit more about some of the underwriting and market caps, projected refi cap versus where the current cap is. That other deal, obviously cap rates are starting to trend upward, but that other deal I think sold at like a 4 cap like a month after we bought it at this at a 6.75. So we're like, pretty sweet. I feel like we're set up. And then this is the demographics. So demographics of Montgomery, why we think it's a good market to invest in. Again, we did this all backwards, but and this is literally just like copy and paste it from Cushman and Wakefield or Marcus and Millichap or whoever of this and this. Like, yeah, strong economy and job growth. Whoop, whoop. Didn't have to do any of this research. Copy and paste. Military jobs, key job, growth news, recent job expansion, development, property management team, FOSHI. Then we always add a frequently asked questions section at the very bottom. And sometimes it's things we already went over in the pitch deck. We've already gone over it. We've talked about it. That's why we talked about it in the pitch deck in the first place. But now that we've got all the way to the end, someone wasn't listening. Their baby was crying. Their dog was barking. They had to go pee, take a break. They didn't hear it, right? So get to the end. What are the frequently asked questions? Well, when will I receive my first distribution? We already talked about that, but I'll tell you anyway. We project the first distribution to be 1 quarter after closing and so on and so forth. So everything we basically already gone over. Maybe some things we haven't gone over, like do you accept retirement accounts, QRP? We went over that. Will there be a cost segregation study for tax benefits? We went over that. Let's see, what didn't we go over? How did the market do during COVID? So maybe that's not necessarily something we went over. Montgomery, Alabama market has lower unemployment rate than the national average and has significantly recovered since the beginning of the pandemic. Why is the seller selling? That's maybe not something we went over either. It's multifamily asset seller owns, and this is the only multifamily asset the seller owns, and they're doing a 1031 exchange into their preferred commercial asset class. What happens if the property is sold? What kind of communication can we expect during the project? Just some of the standard. And this was actually back when we were still called Greenlight Capital before we switched to Three Beach, before we got a cease and desist letter from the $1 billion Greenlight Capital. But we'll sponsor team about you. We've since also integrated this into one. So instead of making it convoluted, confusing of like, yeah, there's 3 of us and we're all individual and do our own things. I mean, that's great, but we want to seem like a team. So we just took a picture of the 3 of us. And now our bio is just a picture of us, Three Beach Capital, and everything that Three Beach Capital has done. And then your next steps, that's always the last page we do. So sign up on the investor portal. We're not even using this investor portal anymore. But sign up. Investments are always accepted on a first come, first serve basis upon the completion of the offering documents and receipt of funds via wire transfer. I cannot save your spot until your cash is in my bank account. Like, you can sign all the docs you want, but if you're going to take 3 months to give me the cash, sorry, can't reserve your spot. Now, there is certain circumstances that we do, like retirement account investors. Sometimes it takes a couple of weeks for them to do all that stuff. And I'm not going to screw them and be like, sorry, it took you too long. So we'll save their spot. But if it's someone like with cash and they're just being lazy to get it to me, I'm not reserving your spot until the cash is in the bank. Deadline to receive wire transfers, always give a deadline. We typically like to give the deadline like 2 weeks before actual scheduled closing. In this instance, it looks like it was 10 days or until the offering is fully subscribed. That way it's like we've got all the cash and we've got a little like a 10, 14 day buffer to receive the rest of the cash if anyone's delayed on that. And hopefully we've got enough. If you guys remember, we said we only need like 1.2 to actually close, but we were raising 2 million total. And then just lastly specifying here's the closing date, but it's also a 506B offering. So make sure you indicate which sponsor you have that relationship with. And that's it, fellas. in an hour or less time, we day one of capital raising. You guys feel like you can raise some cash now? Anyone have any questions about the deck itself or putting together the sample deck?
I had a question on that last page. Where do we find that? Maybe that's my first question. It looks like you have that in a folder somewhere.
I'll add it to the shared drive after the call. I'll add the recording of this. I'll add the template, the pitch deck template, and then I'll add the PDF of like all the verbiage of what we went over today for part one.
Cool. Which section will it be under?
I'll add a new section. It'll be part 7 of like growing your network or whatever.
Cool. And I think I had a question on, okay, wire transfers. How do you, so are you having them send wires directly to you or to a title company? And the follow-up question is, how can you double check wires are coming in?
So good question. What we like to do is we like to do ACH because it typically bypasses the wire fees that you usually get charged by sending a wire. And it's like direct deposit. So as long as they know that they've set up their bank account information correctly, which hopefully they double checked it before they just sent money, then we know that it's going to go to our correct account via ACH direct deposit without anyone having to like mess up any digits because everything's going to be automated. It'll all be through the portal. They'll just click a button, get to the end of their subscription and say, okay, I'm ready to wire my money. Here's my bank account, wire 50,000, wire 100,000, whatever, or submit the ACH. And then it's just direct deposited right into our bank account. So not a title company. All the capital goes directly to an account not like our personal account, but an entity that or a bank account we specifically created connected to the entity that we put together for this particular investment. So in that bank, as far as like making sure the wires or the cash is coming in, we're usually checking if we're in the middle of a capital raise, we're usually checking it every day. Just logging into the bank account and being like, what are there any new wires in today? Are there any new deposits in? Where are they coming from? Typically, we like to request that they put some kind of memo or something on there that lets us know who the cash is coming from. Because sometimes it'll come in and you'll get confused and be like, there's like 50 guys or there's 5 investors that all wanted to come in at 50 grand. Here's 50 grand, but I don't know who gave it to me. And if that's the case, then sometimes what we've had to do in the past, which makes us look like an idiot, so that's why we try to request the memo, we've had to just contact them individually and be like, did you just wire your money? You just wire your money? You just wire your money? And they're like, I haven't wired it yet. And then maybe 2 of them will be like, I wired it. And we're like, dang it. I don't know whose cash it is. So then you maybe wait the next day. The other 50 grand comes in the next day and you're like, all right, cool. It doesn't matter which is which, whether their 50 grand is in. So we always like to at least match up whose cash is who's got their money in, who doesn't. The portal does a lot of that for you, at least the portal we utilize. So that's why we like to require ACH, because the portal will know when the deposit has been actually either like sent and then when it's actually been received from the bank, or maybe it doesn't know when it's received from the bank, but we'll know that it was sent by that person. And so we'll be able to go check. And typically the portal automatically has a memo created that says it came from whatever their name was on the portal, which helps us tie in whose cash that was. So doesn't go to a title company, always goes to us. And we actually, here's a little tidbit of knowledge that we have only just found out. And now you guys are going to get this knowledge. I guess we technically already knew this, but anyway, this is negotiating power information right here. Glad we're recording. So if you're ever co-GPing with somebody, if you're ever going to go in on a deal with someone else, you're maybe not necessarily the lead sponsor. They're kind of doing the majority of the leg lift and you're looking to just come in and raise some cash, or you're going to help asset manage. I don't know. Specifically, this is to capital raising. So you're coming in, you're going to help them raise cash. What I recommend and what we're going to start doing is, because this is the second time that we've done this, because we did the one with Austin, Texas, the Austin, Texas deal. And now we're coming in 50-50 with Chris and Ariane on this 118 unit that we're raising for right now. And so it kind of like helped with our negotiating power to get a 50-50 split because they basically brought us the deal. Anyway, negotiating power. Instead of taking the capital that you're raising and sending it directly to their bank account, because typically that's what people require. When you're like, yeah, I'm going to come in and raise cash for you. Here's all the banking information of where it needs to go. Send it here and it's good to go. Instead of doing that, you create a separate account that maybe is also connected to the entity in some way, like set it up in that entity's name, but make it to where only like you and your business partners, whoever, have access to it. And then you have all your investors send the cash to that account. And then like a week or two, right before closing, when they're looking to get their final amount, you say, hey, look, I've got the 2 million, I've got the 4 million, I've got whatever ready at my disposal. I can wire it to you today. We just maybe need to adjust these terms a little bit. I don't really like the terms you got me. You got me at like 10% of the GP equity, which is like 3% of the total deal. For this to make sense for me, it only really makes sense if we come in at 10-15%. Now, hopefully you've negotiated the majority of that on the front end, because you don't want to raise all that cash and then tell your investors, sorry, we didn't do the deal, I'm not getting paid enough. So it helps with negotiating power, but hopefully you've done the majority of that on the front end. And maybe you can just tweak it just a little bit extra to help you on the back end there of getting that final piece. Anyway, little tidbit of knowledge that we're like, we need to start doing that, because I'm tired of people trying to give us like measly amounts. Luckily, we were able to negotiate a 50-50 split, but they were trying to give us like 20% of the deal. It's like, nah, I'm not interested for 20% of the deal.
Thanks, Josh.
What's up? Any other questions? Y'all all just sitting there. Can't even see Philip or Matan or Casey or Michael. Can't see nobody.
Josh, quick question. When you're doing a pitch deck such as this to investors, what SEC rule, regulations, or guidelines should we be fully knowledgeable about so that we're not breaking anything?
I don't think you would break anything if you're having one-on-one conversations with people, because it's also a fake deal. So it's not a deal you actually have under contract. It's not a deal you're trying to get their cash in a bank account for. It's all just like hypothetical. Like, here's all the hypotheticals of what this would look like. Would you be interested? So from an SEC guideline perspective, there's not even really SEC rules you need to necessarily follow, because you don't have a live deal. If you had a live deal and you're trying to raise for it, then getting on social media and talking about it, if it's a 506B deal, would probably not be good. But if you don't have a deal under contract, if you're not raising for a deal, then there's not really any rules that you're technically breaking. So as far as the pitch deck goes, depending on how you think you're going to set yours up in whatever time, like if you're going to set your deal up to be 506B or 506C, I would just put that in your sample pitch deck. Like this example deal is going to be 506B or 506C or whatever. And, here's the guidelines and whatever for that. So if you're going to do a 506C deal, then like you have to be accredited. Sorry, we can't accept sophisticated investors. You can invest via retirement accounts and QRPs, and we accept that. Maybe accept 1031s if you want to get creative, or Bitcoin. You can get real creative. We accept all these different crazy things, but you have to be accredited. Or if you do 506B, yeah, you can be sophisticated or accredited, but we can only take up to 35 sophisticated investors. So just talking about what the differences are between the two, depending on which way you feel like you're going to lean. So not really like a requirement or a law or rule that you would be breaking, so much as it's just educational information to put in the pitch deck.
I've got another question, and it's like same question, but for the social media side of what we're doing. What's appropriate to share on social media when we're in our lives about real estate?
Good question. So what I'm doing, because I'm in the middle of a raise, right in the smack dab middle of raising capital, and it's a 506B deal, but I'm still going live. So I am making sure that I'm not talking about this deal. I won't be able to talk about this deal until it closes. Like, can't say that we have it under contract and we're going through the process. or that the returns are going to be great or whatever. I'm just not going to say any of that just to prevent any like gray area. I'm going to really more talk about deals that we've done in the past, and maybe the RV park deal that we're doing because we're not raising for that yet, or new opportunities that we're thinking about doing, or our growth of looking to hire an asset manager in the future or whatever. Just going to talk about different things, but I'm not going to talk about the deal specifically that I have that I'm raising for because it's a B deal. So what my post today, my caption was like, this is, if you reach out to me about investing into a deal, this is a very non-specific deal conversation, just looking to foster and build relationships for future opportunities, when they arise. Not talking about deals that we have right now, not trying to get you in on a deal. This is all to build a relationship for future investments. So I had to just be specific with that in my caption. I don't think I actually mentioned that in my live, but I mentioned that in the caption. So if you have a live deal that you have going on and it's a 506B deal, I would not talk about it whatsoever. If you get on a conversation with someone, like if you get someone on the phone outside of social media, have that first phone call with them, have that first touch point of getting to learn more about them, learn about their goals, learn about what they have going on, and then just like drop the nugget that you have a deal. Like, hey, we actually do have a deal right now that's blah, 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 blah. Would you be interested in learning more? And if they say yes, be like, perfect. Let's set up another call to talk about it. So then when you get on the next call, that's basically you talking about it. And then you've at least had 2 touches. So you've had pre-existing relationship with this person. There's so much gray area with pre-existing, but my thing is always, if I've at least talked to them once or twice before, it's pre-existing. They just can't be a extremely cold lead out of the blue that wants to give me money. So if you have a deal that you're raising for, don't talk about it. If you don't have a deal that you're raising for, you can talk about anything that you want. Deals that you previously raised for, that you closed, that you did this with, that you did that with, the returns you got, literally talk about it all. There's no law you'd be breaking because it's not a live deal that you're trying to like raise for.
Sweet. Thank you.
Hey, Josh, quick question. Do you think it matters too much whether you're going live or just uploading a video of yourself to your social media platform?
Yeah, it plays with the algorithm just a little bit differently. The algorithm likes the live videos because it knows that you're actually on the platform, and I don't really know exactly how it works, but I know it gives you more exposure once you post it to your feed after having gone live to that platform. So I wish I could go live on LinkedIn. I'm gonna be honest, I haven't even done the effort to try to get approved. Michael, I think you were talking about you wanted to get approved or something. I'm like, I don't even know where to go to do that. I don't really care, whatever. I'm just going live on Facebook, and then I'm taking the recording of the live video from there and posting it on LinkedIn. So the live feature, at least on Facebook anyhow, I'm probably the same way on LinkedIn. It just helps get you more exposure going live as opposed to posting a pre-recorded video.
Gotcha. Thank you.
I think it also just helps people like be interested in what you got going on, seeing that, oh, he's live, maybe they're not available at that time, which is why you post it for them to look at later. But even when they look at it later, they still get to see that it was a live video that you did, which sometimes entices them to want to like, ooh, maybe I want to watch the next one. I kind of liked what he just talked about, or I kind of like this guy.
So I got a question, Josh, going on that, reposting it. So does it really matter what time you go live, or is there, I don't know. I didn't watch the video yet because I saw the email right before I got on here. So if you talked about that, I can go back and watch it. But is there like a specific time that's better than others?
Good question. It's going to depend on your target audience. What I've found from my audience on LinkedIn is it makes the most sense for me to post between like 9 a.m. Central to 1 p.m. Central. If I can post within that time frame, then I'm going to probably get the most exposure, because that's when the majority of my audience is on LinkedIn. That's when they're using it. That's when I'm going to get all the comments and the likes, which is just going to take the post off and continue satisfying the algorithm and getting more exposure for more people that aren't actually following me. So that's what I found to be successful for me. I don't ever post on the weekend. However, it's a 30-day challenge. We're going to have to post on the weekend. So if you don't see a lot of traction on the weekend, I don't either. And I've been doing this for years. So don't be like, this sucks. No one's watching my video. It's, yeah, it's the weekend. Not a lot of people really get on social media on the weekend, but we want to keep doing it because it's going to help our algorithm during the week. It's going to help us. And it's just going to show consistency, right? It's going to show anyone that you set your mind to do a 30-day challenge and you went live every day for that 30 days. Shows you know how to be consistent, and you will be consistent, which means this guy's probably going to be consistent in closing a deal. Like he's saying, maybe I should talk to this guy. Whereas if you're like sloppy and you miss a couple of days here, a couple of days there, and you're like, sorry, I just got busy. Like, really, you didn't have 30 seconds to just jump on and say, hey, and post it. So it shows, in my opinion, and maybe a lot of other investors' opinion, slightly less like desire or gumption or whatever to like want to get into the business. So
Thank-
the roundabout way of answering your question, I guess anywhere between 9 to 1 is what I found to be good. And that's
Appreciate it.
central. So for you, you're central, right?
Yeah.
In Austin. Yeah. That's what I would say.
There's, I don't know how helpful this is, but in the book 4-Hour Work Week, it talks about how he spent most of his time doing like sales calls in the morning when people are commuting, and then in the evening when they're getting off of work, because that's when they're kind of like checking their phones and available. So, and I've found that to be true too. Like if I text someone at 8, they're most likely to respond versus later in the day.
Right. Appreciate it. Thank you.
True.
And Josh, do these posts, what you're kind of trying to do is really just gather people to just be routed to your media for whatever it is that you're posting. Is that what we're looking at? You're
Yeah,
just
it's
trying
just,
to gather.
yeah, it's like
crowd.
more brand development, brand awareness, really big. You know, the first
Gotcha.
video is like unveiling your secret identity, just kind of getting out there and let people know who you are, what you're doing.
Gotcha.
That was one of the big things that I think was beneficial for me because I didn't really tell anyone at all. There was a bunch of people that reached out to me and were like, dude, I didn't even know you were in aviation. And I had been in aviation for like 4 years. And I was
That's
like,
funny.
yeah, I guess I just don't get on social media a lot.
So I do a lot of Zooms with my community, right? And I do get a lot of traction from like around 11, 12 days. So if anybody here wants to connect with me or us or do Zooms together, because I think that really brings a lot of people in that start following you all of a sudden. So if you guys want to reach out to me, I'd be happy to, since I already have a community that we invite over to those Zooms and make them live. Be happy to connect with you guys so that we can be talking about multifamily versus only the single family that I primarily do.
I think everyone said not everyone has done the video yet today. I know Casey, you said you just got the email, and that's fine. But you know, honestly, you don't even have to watch the video, bro. I mean, it would be beneficial to watch the video. But if you just want to like get on Facebook or LinkedIn and say something real quick and then post it and then and then watch the video after, that'd be fine too.
All right. Sweet.
Austin, did you say you had posted it yet? Philip, I know you said you're still waiting to post it.
Nah, not yet. I'm trying to think about what I'm going to say. Like, do I introduce the challenge or do I just say something random about myself?
That's what I did. I was like, day 1, you can go watch mine if you want. Go to my LinkedIn or Facebook. Day 1 of 30 Creative Capital Challenge, little challenge I put together because I did it back in June of 2020. You're going to see me live once a day for the next 30 days. We're going to be talking about tips, tricks, resources, insider like knowledge about what it is we have going on in the business, and really just trying to foster connections, trying to build and foster deeper connections with my audience and with any potential interested passive investor out there. And I talked about my goals too. So I was like, goals to raise, $10 million over the next 30 days. That's what I'm shooting for, so anyone interested, whatever, reach out to me, PM me. See you guys tomorrow, or however I ended it. So I talked a little bit about the challenge, but also like a little bit about me by telling my personal goals and the challenge I did last year, why I'm doing it this time. So you could talk about your goals and why you're doing this challenge, why you're doing the mastermind in the first place. Like, I'm part of this mastermind, doing this challenge. It's pretty cool. I've never done anything like it before. I'm a little nervous. I mean, honestly, just be honest. I was like, when I did mine back in June, I remember my first like week, every time I got on, I was like, guys, I'm still like insanely nervous. I don't even know what I'm saying right now. Like, you guys can probably tell, hand shaking, you know, whatever the case is. Still figuring this out. We'll get better as we go, but just being honest with people, the whole concept of that personal reality piece.
Sweet deal. Thanks.
Any other questions, fellas? We got 4 more minutes. No? Sweet. Well, I'm sure no one probably has massive traction yet as far as capital raising right now, since it's only been day 1. But in the coming days, in the coming weeks, I think we will start to see some more traction. I was just talking to an investor. I was hosting him on my show, on my podcast, and he's in a similar position that I am, and thinking that the future holds significant opportunity. And there's going to be some investors are trying to like sit on the sidelines right now. You know, a lot of people are saying, oh, it's just hard to raise cash. I think it's just an education thing. I think a lot of investors don't understand what is going to come and what is happening in the future. So if you can just simply and plainly educate them on what you believe is going to happen and how you're fully taking like advantage of what's going to happen, then they'll be a lot more interested. Like this raise that we're doing now, I've had a couple of conversations with people and they're like, you know, we're just in a holding pattern. I can tell you how many times I heard the word holding pattern. We're just in a holding pattern, waiting to see what's going to happen, blah, blah, blah. And I just explained to them why we're investing in this deal in the first place, what we believe is going to be the future kind of moving forward, what we foresee, what we think is going to happen, I guess, what we're already seeing. Maybe you could talk about, here's why you believe there's going to be some more opportunity. And so if you invest in this deal, here's what we can do, right? Like if you just leave your cash where it is now, you're going to get eaten alive by 8.5%, 10% inflation this year and next year. If you just wait 2 years or however until interest rates start moving, or you could at least keep pace with inflation with this deal that we got that's going to pay you 10 per F, and we're going to give you all your cash back by the time you would even think about investing in a couple of years anyhow. And they're like, you got a point, because more often than not, it's not like they necessarily care about liquidity. It just depends on the investor. But a lot of our investors it's not like they're scared about needing to be liquid. They're just not certain what is going to happen in the future. So just simply and plainly trying to educate them on that has ended up selling, so to say, some of them, and being like, okay, yeah, I think I can see that. I can get on board with that. And then they end up investing. Sweet. Big old silent group of faces. How's everyone been? We only got 2 minutes, but is everyone all right? We haven't met since Monday of last week, right? Yeah, Monday of last week. Halloween was good. Last week was good. Underwriting deals, talking to people, making things happen.
You know it.
You know it.
Units in Minnesota might be already, like they've already got an offer on it. So the guy that I'm working with is working to get as many details as we can so that we can potentially do an offer.
Sweet.
You.
Let me know. Keep me posted.
Yeah, I have very little details about it. I have like a potential purchase price, but like that's it.
Like they haven't given you any financials or anything on it?
No, not yet. But like I know where the deal potentially is, and I've looked at like potential market rents, but don't know what it's currently at. The guy that I would be partnering with, he's purchased properties from these guys before, and he was like, they're in great shape, but they're terribly mismanaged. And so a lot of the value add is just managing it better. And so I don't know, I have some basic ideas, but nothing like concrete on the properties themselves. So that's my update. Work on getting more concrete details.
Sweet. All right, fellas, it's Tuesday. We will reconvene on Thursday, and we'll have 2 more videos and lives to do between now and then. So if you guys have any questions about the lives, getting confused, people are reaching out, you got the Slack channel, you got my phone number. Don't hesitate and don't hesitate to reach out, but don't hesitate to do the live video. Like, don't overthink it. I'll be like, oh shoot, what am I gonna say? What's it gonna be about today? Who cares? Just get out there and say something. Cool.